Good morning, gang. Chris Hadley here with Fairway Independent Mortgage Corporation. Yesterday, the Fed Chairman, Jerome Powell, gave a speech and he said that they decided not to raise their interest rate, the federal funds rate, and leave it at 5.25 to 5.5%. Now, you would think that would be good news for the market and mortgage rates, but unfortunately, you would be wrong. The markets didn't like it, and mortgage rates rose by about 0.25% after his talk. This brings mortgage rates to around an APR of about 7.5% for most borrowers. But what the markets didn't like and what caused the rise in mortgage rates was more about what Mr. Powell said that they might do in the future versus what they did. He said that although inflation has moderated somewhat, there is still a long way to go to get inflation down to their target of 2%. Now, he thinks we'll get there in sometime in 2026, but he left the door open for them raising their rate again, maybe later this year. And he also expects this to cause a below-trend growth and softening in the labor market, or in layman's terms, higher unemployment. Last week, we talked about permanent rate buydowns, and as promised, this week, I will talk about temporary buydowns. Temporary buydowns are a way for buyers to get a lower rate and payment for the first 1 to 3 years of their loan, or hence the term temporarily. For example, if we're doing a 1-year buydown for a borrower and they're borrowing $200,000, and let's say the normal market rate is 7.5% APR, they will pay about $1,611, or just a little less than 1% of the loan up front. And for this, their interest rate will be 6.5% APR for the first year. This lowers their payment by about $134 a month for that first year. Then in year 2, their rate goes up to the normal 7.5% APR, and their payment goes up by that $134. Now, if we're doing a 2-year buydown for this same borrower, they would pay about $4,551, or a little more than 2% of the loan up front. And for this fee, their interest rate would be 5.5% APR for the first year, lowering their payment by about $263 a month for that first year. Then in year 2, the APR goes up to 6.5%. Their payment goes up a bit, but they still save around $134 compared to that normal payment, the full payment. And that's what happens in year 3. It goes to the full payment. I know this can be a confusing topic, but that's why you have me and Dana. Don't go it alone. If you have any questions about this type of loan or any others, please give Dana or I a call at the office here at 717-730-4476 or on my cell at 717-571-6384. Thanks a bunch. Have a great day.